I love it when it works. Good morning. Your program says John Shin is going to be your speaker this morning. I'm not John Shin. John Shin is a victim of this. He was going to fly out, but Bank of America and other major organizations have sort of put a hold on travel these days. And it's great to be here from Los Angeles, where I live in Pasadena, but I come up to Kern County regularly to do a few fun things. But this is an unusual morning in that I was talking to some of my compadres and meeting some of you. Shaking hands in Los Angeles doesn't really happen anymore. Somebody flipped a switch, and it's all fist bumps and elbows and goofy moves and social distancing. So it's kind of an interesting time period because we're going to talk about the economic environment. These slides were created in a month ago. A month ago, life was very different. And it's astonishing. I've been in the investment industry. I teach at USC. I've been in the investment business for 35 years in various forms, from investment banking to running money. Now I'm in the private wealth business. I've run a firm. I've worked for large and small. This is a really unusual time period. The fact that the market has really gotten shaken in a month is testament to the power of the global media, the power of the coronavirus, the power of all sorts of interconnectedness that we all live in. But it's also a real testament to diversification. Interest rates have just gone down below 1% across the yield curve. For those of you that are not familiar with the phrase the yield curve, I'm going to show it to you in a little while. But the overarching themes of investing and global growth haven't changed too much. So I want to use this slide. This is a kind of interesting opening slide to talk about kind of bigger macro themes. And in our opinion, a lot of them are still intact. We're going to walk through a couple of these. I'm going to make it fairly short. But at the end of the day, the other part of this presentation that's going to be interesting is, well, interesting for me, hopefully interesting for you, is that I'm going to be a millennial and work from notes from my phone. And I hope I haven't insulted too many millennials. I have three children who are all millennials from 33 to 28, so I love them dearly, but they're addicted to this thing. And I think, frankly, all of us are. That's why Apple stock is seeming to hold up in this deluge. But there have been a number of updates, and you're probably following them as closely as I am. The nature of the world that we live in right now is very connected and very involved in a transparent way. The problem becomes you have this first tone, or this first theme that we're going to talk about, peak globalization, with the current administration in Washington, in the UK, in a number of different countries around the world. The tone of the global trade efforts has changed a bit. I don't know if peak globalization is the right answer. I think that most of you in this room probably remember the phrase peak oil 10 or so years ago, and that was wrong, fortunately for all of us and all of you. But at the end of the current time period is, I don't think Europe would be called breaking down, but it is different. It's a different tone. The trade war with China and the US has taken a different kind of tone. It's more combative. The EU and the Brexit situation have changed, and the EU was created to, after World War II to try and save the world and have them stop killing each other. We hope that continues, but, peak globalization is the end of free movement of labor, goods, and capital around the world. I'm not sure I completely buy that, but it is a difference. And I think that's, in global economics, I think you want to look for the big picture, and changes matter. The next one is a recession on the board. We at Bank of America are not necessarily in the camp that there will be a recession. I think it's likely that a recession could happen. That's as hedged as I think I'm going to get this morning. The notion that we are in a recession or going to a recession is opaque. I was interested, there's a commentator on TV, and a pundit was on TV talking about trying to forecast in today's environment, and he said, it's sort of as easy as looking through a glass of milk, because no one has a very good idea of what is on the other side. Quantitative failure is something that I think is very important to talk about from a thematic world. We are all connected. The quantitative connectivity that we're all in, technology drives your cars, your phones, a lot of your life. It also, from, we'll do a little end around on global economics and talk about the markets. The stock market is really driven these days in a large way by macroeconomic trading algorithms, as they're called. And the algorithms are driving the boat in New York and on the New York Stock Exchange, and you could see it. So this particular downdraft has been quicker and more relentless, because the machines aren't as human as we are. The people that write the code would like to position them as being very helpful to the markets, and they think in logical terms. But when you look at a free fall like Monday, the machines are just pushing the sell button. So it's a little concerning that that's why I think quantitative failure, you've had a lot of quantitative successes. I think all of us in the economic world and, in the investment world, I like to consider myself a practicing economist as opposed to an academic economist. And I recognize that there's a number of different things going on that are working really well because of technology, but there's a lot of challenges that get created at the same time. Demographics and climate change are clearly major themes that you just can't avoid. But robotics and automation is part of what we've been talking about. I mean, the nature of the world these days is so connected that automation is, you're in the economic development of Kern County. Most of the economic development councils around the country are kind of scratching their heads wondering if robots are going to come take jobs. I look at this with a view towards history and recognize that in the Industrial Revolution, a number of people thought that the machines were going to take jobs permanently and people would be out of work and it would be a disaster. That didn't really come to fruition. I'm what's known, and there's a great book that I have kind of glommed onto over the years called The Rational Optimist. I recognize that trends that are in motion don't always last forever because things change. Human beings are in charge. Companies and company management teams are there to take advantage of the economic environment and deliver whatever goods or services, whatever they do for a living. That's why we buy stock in quality companies, put portfolios together that are diversified across different sectors. But we want company management teams that are capable of using automation, using a number of these themes, smart everything, moral capitalism. The ESG movement, environmental, social, and governance, is a major change in the way shareholders are thinking about investing in their companies. So the companies themselves have to recognize that the shareholders are thinking differently, so the company has to think differently. Bank of America is a perfect example. All major companies like B of A, like JP Morgan, pick an industry, Chevron, a perfect example. I saw the CEO of Chevron on Mad Money the other day, and he was touching on climate change, moral capitalism, smart everything. You know, it's a very interesting theme to think about, change that has impacted everyone, and ESG is, it's not fly by night. It's not a light topic. Most major companies are taking this extraordinarily seriously. There's a rating agency out there that judges companies on their ESG score, and it matters. So those are the kind of the big themes, but clearly, the economic outlook from our perspective at Bank of America, we are concerned about the middle box, and I apologize. This presentation is dense, sort of like me, dense. Thank you very much. Try the beef. I'll be here all week. The core of things that we are focused on, this is a presentation that we generally give to clients. I was asked to sub for John, who will bring in the normal economic, easy-to-read charts. That's not us. That's not me. I'm here to talk about how different elements interact. The watch list in the middle is something to really focus on. Inflation around the world has been hiding. I think it's the easiest way to phrase it. Technology is the answer and is the reason why inflation has been so low. And in fact, it's bothering most academic economists, like my new friends over at CSUB. Inflation is absent globally. The concern that we have in this market downdraft and in coronavirus, which we are going to talk about, obviously, is deflation. The concern that markets have and global leaders at the Fed, the central banks in the UK, and the ECB, and the Bank of Japan, is deflation going to be the result of this coronavirus where everybody in the world is hunkering down and not spending money? The country of Italy, let me repeat that, the country of Italy is on lockdown. You've seen the news as I have. They're interviewing people on Skype from their homes. The media, folks that are stationed in Italy are phoning it. It's like a video from the president of CSUB. The world is in a slowdown period, and so what does that mean? That will impact sales and earnings from every major global company. So while globalization has been historically a really good thing, it has helped that the oil industry, not just in Bakersfield, but in Texas and in all through the United States, has been a really powerful additive driver to the economic scene. But at the end of the day, the change that we are in the middle of, that is not about to happen, but no one understands what the next couple of months looks like. So for any of us in the world that pick stocks and we analyze companies and we understand how many barrels Chevron produces in certain different parts, and what are the cost of goods sold and what's the cap structure, that's all very interesting stuff. But China, central bank, Brexit, US trade policy, all of those things go into the fact that we really can't estimate what earnings are going to look like because coronavirus is here. It's fascinating that, like I said earlier, I'm glad that we are shaking hands. The little handouts that are on the table of hand sanitizer are just an indicator of how global this is. I mean, a month ago, did you expect hand sanitizer to be your table gift? No. Oh, maybe it was. Maybe somebody was thinking ahead. But the coronavirus, I stretched to try and find a couple of charts. They're pretty much placeholders, just so we'd have something up on the screen. It's fascinating to see the previous outbreaks, SARS, MERS, the Middle East respiratory, Ebola was pretty significantly different. But this Wuhan coronavirus, or COVID-19 as it's called, what do the markets do in time periods like this? They go down, but historically, this too shall pass. My rational optimist theory of we're going to look through this. Companies will survive. Chevron will still be here. Adventist will still be here. This is a transitory but significant kind of time period, and it's impossible to do forecasting in an environment like this. So all you can do as an investor, what we tell clients from an investment standpoint is, stay the course. You're diversified in your portfolio, large and small, U.S., international, emerging markets, but mostly, most clients with significant wealth have at least, 60-40 stocks and bonds. The bond portfolios have been the rock of Gibraltar and making money significantly for clients, while the equity markets are torturing them and torturing all of us. The sell-off, in fact, that chart 3 down on the bottom left, the multicolored chart, you can see how quickly the upper right chart shows that when the COVID-19 really started to kick in and be part of the conversation, earnings haven't really been affected, ... yet. But the multiple compression is what's going on in the market. And no one can really put their fingers on what the multiple ought to be for forward earnings. So from an economic standpoint, the global economy was very strong going into this crisis. The US economy was very strong going into this crisis. Last Friday, the unemployment number and the jobs number that was printed and was really strong, a very good economic number. Nobody cared. Stock market got hammered anyway. Because this is a chart that we were going to show at the beginning of February. See the date of February 2nd. The 3 lines are 1 year ago, the red line on top of interest rates. The short rate, you can see, was hovering around 2.5%. The 30-year level of interest rates was around 3%. February of 2020, the blue line on the bottom, the short rates had shrunk a full percent to 1.5%. The long rate, the 30-year rate, was 2%. This chart I had created for a speech that I gave last week. I'm going to have to create a whole new chart I should have created a whole new chart for today, except I'm last minute Louis. It's astonishing that the low point on this chart, wherever it is 1% on the x-axis. You see that, remember your algebra, x and y-axis. The 1% line on the x-axis around from short rates, 3-month, all the way out to 30 years. This was March 1st. Today is March 9th. That's about 5 trading days. The entire yield curve is now under that line, that x-axis of 1%. The 30-year bond traded down to 75 basis points. Anyone know what it is this morning? I really didn't look, but it's astonishing. And it's impactful for two reasons. And you have the oil price fight that's being thrown in that I'm here in the oil capital of the world, or at least of Kern County. And oil prices at these levels, when the Saudis are trying to sell oil to China for $30 a barrel to tweak the Russians, everyone is involved in that. Historically, except for producing parts of the world, historically low oil prices should be a positive for the global economy. Lower cost of goods, lower input prices, all the classic, positives that come from lower oil prices, and lower interest rates should be a positive to the economy also. So from a big picture standpoint, yes, the world is not very transparent right now, and all economists and equity analysts and fixed income analysts are really struggling to figure out, what's Chevron's earnings going to be next quarter for the full year. And because of that, what's the multiple that we assign to that? What's the future rate of change of earnings? No one knows, but in a capital structure that has super low interest rates, and you're looking at a backdrop of the global situation that is very highly, not very highly levered, but fairly levered. Interest rates have been low like this. This other chart, let's go back to the other one, doesn't really matter. These are low interest rates, even a month ago. This, 2%, 3%, 30-year money. Interest rates were so low that the US government was talking about issuing 100-year bonds, right? A couple of companies actually did issue 100-year bonds, Disney and Caterpillar. Companies have taken advantage of the low interest rate environment, lower cost of capital, easier to do business. But at the end of the day, now we're in an extraordinarily low interest rate environment. We think that will ultimately help the economy recover from this shock. There are three major shocks that we're in the middle of. It's a demand shock from the coronavirus itself around the world. People are kind of frozen unless they're getting things delivered on Grubhub and Amazon. The demand shock from oil prices, the supply shock of oil, because the demand shock of oil is airplanes aren't flying, the cruise ships, people are canceling trips right and left. So there is a decreased demand, and lo and behold, there's a supply problem because the Saudis have now turned on the pumps, and there's an oversupply and a low demand, high supply. I don't know. I'll look to my academic economists and let them deal with the supply and demand curves and where they meet. I don't know that anybody knows. There's also the last shock that is very important, something that I talked about a minute ago, is the potential deflation shock. Deflation is when prices are expected to go down. Inflationary expectations matter a lot to the Fed, to the central banks around the world. They want to know that we, the participants in the economy, expect interest rates to do a certain thing. If we expect prices to go down, what do? We're not going to buy that car today. We're going to buy the car in a month when it's cheaper. That's deflation. That's bad. That's why the Fed is doing something really unusual for the last few years, is trying to nurture a little bit of inflation in the economy, because it's grease in the gears. It allows people to kind of function normally and buy what they need to buy today before it gets more expensive. So the long and the short of all this is the accommodative Fed has been supporting the expansion for quite a while. They will probably, and we believe that the Fed and central banks around the world will have to get together and create a little bit more stimulus. We probably expect at least 50 basis points cut at the next Fed meeting this month. Interest rates are going to be coming down, but this can't be solved with monetary policy. Fiscal policy and the government in Washington has put forth that they are going to talk to the Congress and try and get some fiscal movement so that they can accomplish some fiscal growth, stimulus into the economy. That might happen, it might not, but it will happen because, our opinion is it will happen because the markets are going to force their hand. So the Fed is going to be supportive. They will probably continue to do another round of QE and purchase of securities. But earnings growth is the real key. This has been a chart that has been in our pack for a long time. We believe that earnings drive stock prices, but the trade tension and the upcoming election that we're in the middle of have really changed the picture from what we expected a couple of weeks ago. This is an interesting chart in that it goes back to, it just goes back to the December of 18, but what it shows you is how the market reacts and has reacted positively, even with some shocks along the way. So this is a serious shock, but at the end of the day, when earnings clarity starts to come through, we're feeling better that the economy is pretty well positioned. The last thing that I will put forth is we at Bank of America, you won't be surprised that we do business with 1 out of 2 households in America. Checking accounts, debit cards, credit cards, whatever. We actually, it's not quite Big Brother, but we are monitoring the spending that is going on. We are privy to a fair amount of data. Consumers are still spending at the same rate that they have been spending. That's a real positive. Consumer spending is 70+% of GDP, and as long as consumers are still spending, they're still relatively optimistic about the outlook and feel good about their jobs. At the end of the day, I'm going to leave it there on a high note. That's about as high as I can possibly get in this day and age. But this is a very unusual time period. Expect a strong policy response. I thought it was going to get announced last night. Richard, you can come up and kick me off and answer questions. I'm glad to take some questions. Do we do Q&A? I think we're done. No Q&A. So catch me somewhere else. Thank you very much.